Howdy, Jacob here. Today we're looking at TJX companies in the specialty retail industry. They operate through four segments: Marmax Home Goods, TJX Canada, and TJX International, incorporated in 1962 out of Massachusetts. 109 billion market cap, 106 billion enterprise value. I forgot if I already said that. 29 billion in revenue in 2015 to a little less than double to 2024 of 54 million. So pretty impressive growth for being around since 1960 in my perspective. Gross margin has increased. Operating margin is actually down a little bit. Earnings per share still up quite a bit though. And dividends up quite a bit. Return on invested capital lower than what it was 10 years ago, but you're still at 25% return on invested capital. Balance sheet shows 5.6 billion cash on hand with 2.8 billion long-term debt, zero short-term debt. They could write off all their debt right now with the cash they have on hand. Very safe investment from a balance sheet perspective. Cash flow has a little bit of reinvestment, which we can see through their capital expenditures, almost doubling over the last 10 years, but their cash from operations have also doubled. So hefty production of free cash flow and good growth there. Interesting. Looks like in the last week or so, Quick FS actually added a free cash flow, the free cash flow line to their cash flow statement. So that's cool. I'm not sponsored by them or anything. I'm just saying, very cool. Use of cash seems to be mostly dividends and share repurchases. So that is probably why their return on invested capital does look a bit inflated. If the company does not reinvest back into themselves, then there's no premium necessary due to the fact that although they have a high return on invested capital historically, they haven't actually reinvested at those rates. So if a company is reinvesting at huge rates of return, then obviously that can deserve a premium and will likely lead to more efficient, higher growth in the future. If a company is just handing back their money of free cash flow through share repurchases, which inflates their return on invested capital figure, especially since they've been around since 1960, or just hands it back in a dividend, there's really no necessary premium on that figure outside of growth, in my perspective. And so I think I'm ready to make some assumptions here. Revenue growth, I think that mid single digit seems appropriate to me. Maybe let's do 6%. I think at the end of 7 years, there's a little bit of a premium necessary, but their margins aren't crazy. Return on invested capital is high, but they're not reinvesting it. They're really just hitting it back to the shareholders. So I don't think too much of a premium is necessary there. Margins, I do like that. Free cash flow is consistently higher. Let's do something like 6.5. Well, let's do something like 7.5. And for share repurchases, 1% would be about a billion, inclusive of stock-based compensation. You're looking at like 1.2 billion. So half that, 1.8 billion, would be about a share percent and a half. So let's assume that. So that's about 1.8 billion. 5-year average free cash flow about maybe 4 billion, 3.5 billion. That leaves 1.5 to $2 billion. The dividend is paying out well under that. So the dividend is paying out 1.5 billion. The payout ratio is maybe 40% or so. Not crazy high there, but I don't want to increase that too much. I do think that there's other opportunities here. So let me increase that in line with roughly in line with their revenue growth and share repurchase rate. This will leave about $500 million or maybe 15 to 20% of their free cash flow to reinvest to get to this rate of return, make acquisitions that make sense, hopefully efficientize, make the company more efficient. But I think I'm pretty comfortable with these assumptions, and right now it just looks a tad expensive for me. But I do hope you enjoy the video and have a great rest of your day. Thank you.